Hi guys, I'm Karunya Rao, and in Ideas for Profit we discuss State Bank of India. Well, if you look at the numbers, SBI's Q1 performance was quite a stellar show. The bank reported its highest ever quarterly profit amid the second wave of COVID-19 despite muted loan growth, margin contraction and higher operating expenses. Net profit rose up to 6,045 crores in first quarter, a growth of 55% year-on-year. Low credit cost underlined the bank's earnings during Q1. Bank scored pre-provisioning operating profit if you exclude the one-off of stake sale in SBI Life. That increased by 15%, indicating a reasonably good operating performance. But still, there were a few disappointments in the bank's performance. There was one in the form of weakening asset quality and, of course, a muted loan growth. SBI's slippage ratio, which significantly moderated in the past couple of years and fell to a record low of 1.2% in FY21, increased to 2.47% in Q1 of FY22. The bank saw an elevated level of slippage of close to 15,666 crores in Q1 FY22, led by higher slippages in retail and SME segments. However, this shouldn't be a cause of concern. The blip in asset quality was caused by COVID's second wave, which impacted the cash flow of retail and SME borrowers. The management has clarified that loans worth 4,800 crores have already been recovered or upgraded in July. Restructured loans were contained at 20,300 crores, a mere 0.9% of the loan book as of June end. More importantly, SBI's high provision coverage ratio of 86% and additional provisions of 9,065 crores provide a lot of comfort. Despite a robust growth in retail book, SBI's overall loan growth was muted due to weak credit demand from corporates. For the banking industry as a whole, corporate credit growth has remained in the low single digits over the last 7 years in the absence of private investments and deleveraging that's been done by corporates. But this may change in the coming years. Strong demand in post-pandemic period can lead to increased capacity utilization of industries and propel private investment related to credit demand. Also, the government's thrust on capital expenditure should aid the revival of the capex cycle. The kick-starting of the capex cycle will lead to substantial valuation re-rating for SBI, the stock which can trade materially above the long-term average valuation. The goal of a $5 trillion economy cannot be achieved with just consumption demand. It has to be supplemented with equally strong investment demand. While the direction is set, the timing of revival of investment demand is unknown. And precisely for this reason, SBI is available at below forward book value, presenting a good opportunity to investors to accumulate the stock for the next leg of re-rating. While SBI's overall advances growth was muted in Q1, retail loans increased by 16% YOY. Corporate book, which constitutes 30% of the overall bank's loan book, contracted by 2% and it dragged down the overall loan growth picture. Home loans, which is the largest subsegment within retail, grew by 11%. Express credit grew by 34%. There was good traction seen in gold loans as well. SBI saw 9% YOY growth in deposits. CASA growth, or rather CASA deposit was up 11%. Term deposits grew 8% as well. CASA share was steady at 46% at end of Q1. Meanwhile, NIMs contracted to 3.15% despite significant reduction in cost of deposits facilitated by low interest rate environment. Though interest rate reversal due to elevated slippages impacted the margins in Q1, SBI's NIMs are much lower compared to private peers and have a scope of improvement. Subdued loan growth and margin contraction led to weak growth in net interest income during Q1 of FY22. Fee income was up 20% YOY on a low base. Operating expenses increased by 13% YOY as well. Consequently, cost-to-income ratio inched up 52% in Q1. Operating efficiency can improve significantly if the bank continues to lay thrust on digital growth. NPAs inched up slightly due to higher expenses. However, assets above 5 crores showing early signs of stress remain steady, which is very encouraging. Fall in provisions by 20% YOY was a key driver for profits. Thanks to strong internal accruals and raising capital through 81 bonds during the year, SBI remains adequately capitalized with Tier 1 capital ratio at 11.32% as of June end. The bank doesn't see any urgent need to raise capital as long as capital ratio stays 100 basis points above regulatory requirement. We highlighted SBI as a tactical pick and the best play amid the uncertainty after the first wave of COVID in August last year. We echoed our optimism on the stock by again recommending it as a weekly tactical pick in April amid the second wave. The stock has more than doubled since then. The upside was driven by resilient performance in a pandemic year. And despite the rally, valuation is still low at 0.9 times FY23 estimated core book value. SBI is trading below its long-term average historical valuation, though the return on equity has now improved to low double digit. While the receding asset quality woes led to valuation getting re-rated from 0.3x forward book in August last year to 0.9x forward book currently, the strong earnings aided by economic recovery will drive the future stock performance. Subsidiaries are also getting bigger and better and will add to the stock upside. Long-term investors should therefore buy SBI to gain from the next leg of re-rating.